I wanted to start by a word of caution because what I heard today resonated somewhat with my banking experience. In fact, I spent 25 years looking at the bank industry, and some of the things I heard today remind me about what happened between the late 90s and the early 2000s in the bank industry. The situation was of the bank industry at that stage, just think about it. We had margin pressures, and the risk was less and less priced. There was a lot of inflows of new capital and liquidity in search for yields. The banks had an enhanced capacity to sell risk or to share it. You had conduit, securitization, derivatives. A number of industry participants were seeing their competitive position at risk and were struggling to achieve decent return on equities in their core business. And so they had the incentive to diversify away in new geographies, new products. The market was full of innovation, which was really a constant phenomenon. And in parallel, when you were talking to bankers, they were increasingly confident with the level of their risk management, with their models, which were more and more sophisticated, with their ability to manage their risk, sell them. I would not quote some of the kind of statements I receive when talking from CROs from large banks in the US or in Europe, but again, the industry was overconfident. I would clearly, and then over time, incrementally, we saw loosening of underwriting standards, we saw increase in risk appetite, massive increase in leverage, and very, very aggressive liquidity management. So again, when you look at the reinsurance industry, clearly the picture is very different. What I heard today, what we see is a very strict and still strong risk culture. The level of leverage is at historic lows. Investment portfolio are still run in a very conservative way. So again, nothing to compare to what we saw in the bank industry, but again, it was quite striking to me. Over the day, I was just listening to that and was just thinking of vague souvenirs from the bank industry, telling of how strong they were at a certain stage. Now, coming back to today's discussion, in terms of key points worth noting, what is clear, what emerged is that the industry is challenged to sustain returns given overcapacity, lowering demand for reinsurance, new entrants, and again, the current return on equity are not sustainable. We are also seeing probably that size, something what emerged was that although smaller players may find their niche, size is a factor, and again, smaller players may be more challenged than larger players to face the current market. We are also seeing some extensions of terms and conditions during the renewal season. We could drive to increase risks, and the fact that we are seeing negative price pressure should not hide the fact that on this side, incrementally, we are seeing some developments. And capital management is a big theme, knowing that what can you do with this excess capital? Deploy it, acquire, make strategic acquisitions, M&As, returning back to shareholders, so plenty of things. Conversely, on the good side, I would say that it seems clear that the industry has managed, strengths start with its talents, and the industry has managed to invest in its talents. And again, we heard a lot about increased a lot of investment in human capital, and that's and an improved expertise, which has accompanied the growth in the sector. A second element, which is also very clear, is that enterprise risk management continue to be an industry cornerstone. And by the way, we have a lot of strong ERM scores in our ratings of the industry, and we generally believe that the reinsurance industry has stronger risk management capacity than typical insurance industry. We have above average score there. And they are also, and the risk culture again remains strong. Last thing is that despite all what we said, what we heard about, challenge, overcapacity, new entrants, reduced demand from large primary insurance companies, there is still room to grow through innovation and other elements. So again, but when we tie all this together, as I mentioned in my very brief introductory remark, we have a negative industry trend, many stable outlooks, but again, we are cautiously negative on the industry. And again, what we will continue to assess and monitor very closely in the coming years is trends in the underwriting standards. This is about the leverage. This is about investment policy. We heard that, incrementally, we could see some change in investment portfolios composition towards more risks. Competitive position, again, of smaller players will also be a key focus of our attention. And again, these are the elements that could lead to move our stable outlooks to something less, a bit more negative. And again, a comment I really appreciated at the beginning of this session was, we tend to overestimate change which happens over 2 years and underestimate incremental change which takes place over a decade. And I think this is we're talking about something long term, but again, it's something good to keep in mind. At this stage, I would like to thank you all again for joining this S&P and PwC conference. It was great. I would like also to invite you, as you know, we have a very large S&P conference in New York taking place in June from the 9th to 11th in New York. And again, there will be some panels on reinsurance, so you are more than welcome to come. We also welcome your feedbacks, and we will circulate forms. I understand that they're going to be sent probably through internet, so please provide your feedback on this session because we want to make it better. And again, whatever you can provide will help us to make it better next year. And again, in terms of location, I think we had a good day, but probably the location was not as good as we would have liked it to be. And thanks to Mr. Abramovich also. So we will send him an email. And otherwise, we're going to have a cocktail now. And you are all invited to the ILS cocktail reception, which is taking place upstairs. Starting, I can't remember when it is starting, but it's in your... at 6:30. So, yes, I think we have some drinks here, I understand. And again, thank you all very much. Goodbye.